Despite what you might expect, the pandemic and the lockdowns over the last year have actually led to some of the strongest market sentiment ever recorded. Now, if you went back in time and asked any economist ever if a worldwide pandemic that killed millions and shut down pretty much every country in the world would help or hinder the economy, I'd be willing to bet everything I own that they would say it would hurt the economy. And it did for a while. The lockdowns came into force, and while they varied in severity by state and by country, the widespread effects were pretty much felt everywhere. People weren't allowed to go out unless for essential reasons. They weren't allowed to spend their money at a restaurant or a cinema. They weren't allowed out to work their jobs and earn their income. Children were prevented from going to school, traveling abroad was practically prescribed, and businesses of all kinds were just shut down. And as this situation developed, the markets crashed, as everyone expected them to. What we didn't all expect was that the markets would rebound faster than ever before, which would lead to the strongest bull run in US equity history. Never before has the stock market in the US risen as quickly as it has over the last 18 months. The only problem is that this has been a market in denial. The economy and the market have been behaving as two entirely unconnected entities, as if they weren't related at all. The truth is that the market and the sentiment behind it right now is really strong, and at the end of the day, it mostly comes down to this idea about a rebound in our economy. Companies are projecting record growth and earnings. People are expecting their investments to shoot up in value because people were, all at once, finally allowed to go outside and spend their money again. The problem is that the market seems to think that the initial economic hit never actually happened. 1 month ago, it was announced that US GDP had finally reached pre-pandemic levels again, which sounds great on the surface, but in reality, it isn't. You see, that doesn't take into effect the opportunity cost, where the economy would be if COVID had never happened. And it also doesn't consider the huge levels of inflation that we've seen over the last year. Unrecorded inflation, I might add. The truth is that the economy isn't in great shape, despite what the markets would make you think. And the banks, the financial institutions that dominate our markets, well, they're afraid for our economy as well. And that's what this video is really about today. Why the banks are afraid for the economy and why we should care about it. But really quickly, if you could just hit that like button, it gets YouTube to send this video out to more people just like you. If you're like me, you value your privacy and your freedom, then you need to hear about this video's sponsor, NordVPN. They are a provider of VPNs, virtual private networks, which can help to stop your data from being spied upon by your internet service provider or any unwanted eyes. NordVPN can help you disguise your traffic to make it seem like you're somewhere you're not. You can pick between thousands of servers and 60 different countries. This can be great to access those websites that might be blocked in your country from the government or from any geo-restriction laws. By using a VPN, you could really easily get around those bans and visit whichever sites you like, regardless of where you are. Or you can just use NordVPN to watch Netflix from another country. Say you heard that The Office is on the UK's Netflix, but it's not on yours? Well, you just very simply select the UK. NordVPN then makes it appear as though that's where you are, and just like that, you can watch The Office without having to go on some dodgy streaming site. NordVPN are one of the best known and most trusted providers of VPNs out there, and if you're considering using a VPN at all, then I highly suggest you check out the link in the description or go to nordvpn.com/stoicfinance to get a nice discount and try the service for 30 days with a guarantee of reimbursement. So as I just touched on, the general forecasts for pretty much every country, not just the US, were really positive. The prospect of lockdowns ending and people getting back to their normal lives led to economists expecting a rapid recovery of GDP due to a number of reasons. Firstly, people would be making up for lost time. We were expecting people to get outside, to spend money, to buy food and drinks and enjoy themselves, and in general, spend far more money than usual. This was boosted by the fact that pretty much every demographic had actually managed to save money during the lockdowns, meaning people were feeling wealthier. The programs that were made to help stop people going bankrupt during the pandemic put money in people's pockets, whether it be via unemployment and stimulus or furlough and universal credit. People were expected to spend through their savings, go back to their usual way of living, paycheck to paycheck, and stimulate the economy in the process. We were also expecting unemployment to rise at pretty incredible rates. Suddenly, businesses would find themselves much busier. They would have to hire people to fill their newfound demand. We would need more truck drivers to move goods around and more waiters to service our restaurants and more middlemen to facilitate all this newfound economic activity. And this effect would be multiplied because those people who were hired because of increased spending would then start spending more themselves, pushing the economy further along still. And to make it even better, Wages are rising in lots of industries. Chipotle have raised their wages for every location in the US. Truckers are getting paid more as their services are in demand. Pretty much every bank in New York has announced an increase in salaries for their associates, and tech companies have done the same. Vaccinations have been progressing forward at an incredible rate. First world countries all over, from the US and Canada to Europe and the UK, around 80% of adults have been vaccinated, and almost all of the people who actually want to get the jab have got it. The risk of the virus spreading is therefore reduced, and the risk of dying from it has been cut right down to the point that lockdowns are starting to look like a thing of the past. When the UK opened up a couple months ago, the rest of Europe and the opposition here called it a dangerous and reckless experiment. But contrary to what Labour said would happen, there was no sudden influx of deaths or hospitalisations, and our medical services have not been overwhelmed. People are more confident as a result of this. Not only are people meeting up with family and close friends for foods and drinks, but they're attending large-scale events just like they used to. Football matches and F1 have crowds again. Festivals are allowing tens of thousands of people to listen to music all together. It was starting to look like the idea that people would be afraid and reluctant to go back to their old ways in light of the virus was wrong. In the UK, masks are no longer mandatory in most places, and as long as you haven't had a positive test, you can pretty much live your life as you wish. And this sentiment is echoing all over the world. People are returning to the offices. The economy seemed to be booming. Forecasts for GDP growth were approaching 7 or 8% all across the developed world, numbers that would shock anyone just a few years ago. But then, all of a sudden, this progress started to slow down, and it started with the Delta variant, a strain of the virus that developed somewhere in India and proved to be more contagious than the original. It spread across the subcontinent and out into the rest of the world. Within a couple of months, it was present in almost every country, and it was starting to become the dominant strain. It actually seems as though it's a little bit less dangerous than the original virus, which means when some people get it, they don't notice and they go about their lives and spread it further. At first, the news surrounding the Delta variant seemed unnecessarily pessimistic. The BBC and other supposedly reputable organisations were frequently bringing on scientists who screamed at us that the vaccines would provide us with zero protection against this new strain, and of course they were wrong. The vaccines do still work, just not quite as well. In places where vaccine uptake is high, truth be told, there isn't really anything to be afraid of. We have the data now, and the truth is that if you're young and healthy and vaxxed, then there is almost a 0% chance of kicking the bucket. But for those who are already sick or old, the vaccine is failing to save around 10% of them. Now, while at first it appeared as though the threat of Delta wasn't enough to keep people at home, that may have just changed. Over the last month, new data has emerged which makes it appear as though the supposed rebound effect won't be as large as expected. This chart here shows retail sales growth across Europe, and you can clearly see that retail sales are down from last month. Car sales have dropped as well, 22% in the UK, 23% in Germany, and 11% in US month over month. This chart here shows us if businesses are producing more or less than last month, and while they are still increasing output, that increase is reducing. In the US, the increase in jobs and employment has been overwhelmingly positive for the first half of the year, but that appears to have stagnated as well. Last month in August, we were expecting around 750,000 new jobs, but we only saw 235,000. Despite a job deficit of 7 million workers across the US and rising wages, people don't seem to be lining up to start working as much as we expected. Now, you might say that this is still an increase in employment, so it can't seriously be considered a problem. But there is a problem here, because of the thing that I'm sure you're all getting tired of hearing about, but I have to mention it nonetheless. Inflation. The Fed has been pumping money into the economy at an incredible rate, and it's been doing this, by its own admission, to create jobs at the expense of inflation. While at first the Fed denied that inflation had anything to do with the increase in M2, that's not their position anymore. Now they are saying that their priority is increasing unemployment, and it's okay if inflation rises a little bit to reach that goal. Surprisingly enough, the markets just accepted this, on the basis that employment is obviously good for the economy and it's growing so quickly that the Fed will start to taper soon anyway. But this recent huge jobs miss means that that might not be the case. If the Fed really is determined to increase employment via QE, then they're going to have to keep it up for a fair few more months. And if the jobs outlook doesn't improve, if job creation remains at 250,000 every month, then this money printing isn't going to stop anytime soon. We've already seen inflation of 5% year over year, and unfortunately, the data for the most recent month isn't available to me while I'm writing this video, but it will be available when it comes out. If you're watching this and inflation is 5 or 5.5% year over year, then maybe my fears are unfounded. But if it's 6 or God forbid, even 7%, then the prospect of the Fed continuing to print money should scare us all, and it is starting to scare the banks. According to JP Morgan, consumer spending has been falling over the last month, and they believe it is due to fears around the Delta variant. Spending on their credit cards has fallen dramatically when it comes to things like travel and entertainment, and Google search trends for COVID and the Delta variant have all risen considerably. That leads them to conclude that it's this rise of the Delta variant which is stopping people from spending their money. And Bank of America agree with this as well. They're seeing the same decrease in spending on their credit cards, with the largest declines being in clothing and airlines, but also groceries and online retail. Lending requirements for banks all over the world are tightening. You might remember a few videos ago where I mentioned the Mortgage Credit Availability Index, which records just how easy it is to get a loan and how it dropped sharply in July. But it's just fallen again, meaning that banks are tightening lending requirements even further. The banks are only willing to lend to the most qualified borrowers, those who they know will be able to repay their debts regardless of how the economy performs. It is clear that banks across the world are worried about the state of the economy going forward, but I do have some concerns about whether or not it is actually due to the Delta variant. When Bank of America said that some of the largest declines in consumer spending has been on groceries and online retail, that doesn't strike me as something that has been caused by the virus. If people are afraid of the virus, they're not going to spend less on groceries and they're not going to be avoiding online shopping. I personally think that it's more likely that this decrease in spending is people just being a little bit cautious. They're not sure where the economy is headed, especially with inflation and home prices behaving the way they are, and people are just being a bit responsible. Unfortunately, I don't have any data to support this idea, but I still can't help but feel that something just doesn't quite add up. I personally don't know anyone who is afraid of the Delta variant today, whether they're old or young, and I especially don't know anyone who is avoiding spending money on food because of it. The truth is, I'm not 100% sure why this is all happening, and I'm not 100% sure that it's going to continue to happen. But right now, the data that has come out over the last month is looking more and more pessimistic. If you're new to the channel and you enjoyed this video, then make sure to subscribe. If you want to help spread the word, then consider liking the video and leaving a comment, and YouTube will do its part by pushing this video out to more people just like you. I really do appreciate all the support you give the channel, even if it's just leaving a like. Also, make sure to check out this video's sponsor, NordVPN. If you want to help out further, there is a link down below in the description to BlockFi where you can get up to $250 in free Bitcoin, and you can earn interest on whatever crypto you hold, whether it's Bitcoin, Ether, or a stablecoin. You can earn as much as 14% interest a year. There's also a link to my favorite brokerage called eToro, where you can trade stocks and shares, crypto commodities, foreign currencies, and more, all for 0% commission, so make sure to check that out too. For those of you who maybe haven't seen, a few days ago I got an email from YouTube threatening to delete my channel. I'm still not 100% sure what's going to happen, but it is starting to look more positive. But just in case the channel does get deleted, make sure to subscribe to my backup account, Stoic Finance 2, and my brand new crypto channel, Stoic Crypto. And of course, follow me on Twitter as well. I'll put links to those in the comments down below. I'm also working on setting up my own website where my videos will be published in the future, and I'm going to be setting up a Patreon as well. In general, I'm just trying to diversify because even if this does work out and my channel isn't deleted, this really has given me a kick and reminded me that it's just too risky to have only one channel. I don't want to have to censor myself at all. I want to keep making the videos that you guys want to watch, and expanding this brand onto other platforms will make sure that I'm not at the mercy of YouTube. Thanks for all the support recently. Thanks for watching. Until next time.